We are counting down. Kowalczyk joins me here on the Hong Kong set. He is the Chief Investment Strategist at CFC Seymour. Good morning, Dariusz.
Morning.
What are we expecting from the Hong Kong market today?
I think that we are going to open higher, about 200 points, purely because the US market closed half a percentage point up yesterday, and S&P futures are pointing to further half a percentage point in the morning already. So by way of correlation, we have to move up. And then it all depends on Chinese GDP data.
Now, what are you expecting from that?
I think that we're going to see a sharper slowdown that investors are anticipating. And our call is year-on-year growth in the first quarter of only 9.5%. Now, if that happens, I think the market will react positively to such data, thinking that the government will decide not to tighten monetary policy too much since the economy has slowed already. And looking at how stocks responded to GDP data last year, below consensus reading should actually be positive for the equity market.
Now, what about those tightening measures? What kind of measures could we expect?
Well, I think it's still quite likely that there will be another increase in the reserve ratio for the banking sector, just because there is still huge inflows of foreign currency into the country that the central bank has to then drain, and this is increasing the money supply in the banking system. So I would go for some modest increase in that ratio, and possibly a little bit of tightening of interest rates, primarily to increase the deposit rates for households, because they are negative in real terms right now.
Now, what about CPI and PPI? How is the inflation situation? That data is expected later this week, and what does it mean for the yuan?
Well, I think that there will be some slowdown in CPI. We are going for 8.3% year-on-year, very high, but down from 8.7 last month. And because this would mean that inflation has peaked, probably policymakers will be able to say that, well, we do not have to allow for such strong appreciation as we have so far this year, because inflation is already easing, so we don't need to use the currency mechanism to the same degree to mitigate price pressures. As a result, I think that appreciation of the yuan will slow for the remainder of the year. We are going for 6.6 against the dollar by the end of the year, which is a much slower appreciation that consensus is calling for right now.
And very quickly before we go, now HSBC says we're seeing a bear phase in Asia, and it's going to last for 6 months. Do you agree with this? Well,
we are seeing a bear phase, but I don't think it will last that long. I expect that the US stock market will not see the lows that we saw in March, and probably Asian markets will not see them either. So I would be quite optimistic for especially the second half of this year.
Thank you for joining us today.
Thank you.
I've been joined by Kowalczyk. He's the Chief Investment Strategist at CFC Seymour Limited in Hong Kong. Martin, back to you.
All right, thanks so much, Emily Chan, our star